Good morning, and welcome to episode 245 of Getting Rich. I'm your host, Rich Checkin, president of Asset Strategies International, and today is Wednesday, October 8th, 2025. Yesterday marked the 2-year anniversary of the Hamas attack on Israel, which led to intense hostilities in the Gaza region. Leaders of both Hamas and Israel are meeting in Egypt through intermediaries to discuss an end to hostilities, return of hostages, and the future administration of the Gaza Strip region. Here in the U.S., the government shutdown continues. Very little progress is made between the two sides, Democrats and Republicans, but there is plenty of finger pointing and blame to go around. My question to you is, in the end, do you think that this government shutdown will end with a balanced budget? I have my serious doubts, but I'd love to hear your thoughts on the subject. Go ahead and send them in, and we'll air them and comment on them next week. Gold does not seem to think that we're going to end up with a balanced budget. Gold shot through $4,000 an ounce like a hot knife through butter. That's leading Goldman Sachs to up its forecast. It believes that gold will break $4,900 an ounce by second quarter of 2026. Morgan Stanley came in late last week, and this was mentioned by our good friend Chuck Butler at the Daily Pfennig. If you don't get that daily, my gosh, you ought to. But Chuck raises a good point that Morgan Stanley went ahead and changed its allocation for its portfolios. It had suggested 60% stocks, 40% bonds for the longest time. They've recently come out with new guidance: 60% stocks, 20% bonds, 20% gold. Okay, so they're cutting their bond allocation in half, and they're putting it all toward gold, from 0 to 20% of a portfolio in the blink of an eye. Now, does that have an impact? It may very well. Let's face it, Morgan Stanley's got $4.8 trillion assets under management. A 20% shift is about $960 billion heading into gold. That's roughly 240,000 ounces or 7.7 metric tons. And that's just one blue chip brokerage firm. Folks, I think it may have an impact on the market before long. I don't think Morgan Stanley is going to be alone here in changing their allocations. Let's go ahead and take a look at the numbers, and then I'll touch a little bit more on that impact going forward. So gold today sits up 3.9% at $4,037.90 an ounce. It was $3,887.60 last week. Silver's up 3.6%, right at $49, a dollar away from its all-time highs at 50. It was trading at $47.28 an ounce last week. Platinum's up 4.4% to $1,662 an ounce. It was $1,592 an ounce last week. And palladium's up 13.3%, being very volatile over the past several sessions. It's at $1,414 an ounce. It was $1,248 an ounce last week. With gold slightly outperforming silver, it's going to take more ounces of silver to buy that ounce of gold. So your gold silver ratio is up slightly to 82.41. It was 82.23 last week. And despite the dysfunction in Congress, the lack of a working active government, the dollar has surged a little bit. It's trading at 98.82, up about a dollar. It was 97.81 last week on the legacy index. So, I'm hearing a lot that gold is near the top. It's too late. You waited too long. I'm telling you, nothing could be further from the truth. We are still seeing incredibly low premiums, but they are starting to tick up. So central banks have been involved in this trade for a long time. Investors now are finally starting to wake up and get in this trade. We know that because the premiums are starting to move higher. And we're seeing silver move as well, which is something that investors buy when they buy gold. Central banks don't buy silver. So as gold was moving up, that gold silver ratio number was extremely high, 90 to 100 or higher. It's down around 82 and change right now. So that suggests premiums are coming up with investor interest. Silver is moving up in price because investors are getting in this game. You have not missed out. None of the factors that would suggest that this is an end to the bull market in gold are firing right now. I'm talking about duration, the gold price, interest rates, US dollars, gold silver ratio, Dow gold ratio, investor sentiment, geopolitical stability, domestic stability. None of these things suggest that gold is turning the corner. You've got plenty of time to invest, and I suggest you do so before the premiums get out of hand. But either case, you need to have it in your portfolio. We're going to discuss this and a whole bunch of other things tonight from 7 p.m. Eastern to about 8:30 is usually when we wrap up. It'll be myself and my co-host, Adrian Day of Adrian Day Asset Management, and we are welcoming John Duty of the Gold Stock Analyst. John's reputation precedes him, one of the best resource sector stock pickers known out there. We're going to have a fantastic discussion. Please join us. Ask us your comments or ask us your questions during the webinar so we can get them answered there live. It's a free webinar, but you got to sign up for it, and you can do so right below the video in the notes section. As always, go ahead and follow us on social media. Like us on YouTube and send us your comments and questions. Sign up for our Always Something Interesting alerts and our information line newsletters below. But in the end, don't ever forget, getting rich starts with keeping what's yours.